Welcome back to the deep dive. Today we're going to be tackling something super important, especially if you want to understand how businesses really work, or even just manage your own money better. We're diving into financial management.
Ooh, sounds exciting.
You handed me this study guide and a few other things, and I got to say, it looks like we've got a lot to cover.
Yeah, we do. The study guide is really thorough. It covers, like all the basics of financial management. And I think by the time we're done with this deep dive, you're going to have a really good understanding of financial statements and stuff. You'll be able to make investment decisions and even wrap your head around some of the more complicated things about financial markets.
Okay, so that sounds pretty ambitious, but I'm up for it. Where should we start?
Well, the study guide kicks off with the role and environment of managerial finance.
Okay.
So it's all about setting the scene and understanding what financial managers actually do within a business.
All right, so let's say I'm stepping into the shoes of a financial manager. What's my day-to-day like?
Well, first and foremost, you'd be making these big decisions about where to invest the company's money.
Hmm.
You'd be analyzing investment opportunities, weighing the risks and returns, and ultimately deciding which projects to go for.
So it's kind of like being a financial detective, right? Trying to find those golden opportunities for the company to invest in.
Haha, yeah, that's a great way to put it. And once you've, identified those opportunities, you've got to figure out how to actually finance them.
Right.
This might involve getting loans, issuing bonds, or even, raising money from investors.
That sounds like a real balancing act. Like you're juggling the need for cash with the cost of capital and all the risks involved.
It totally is. And through all of this, you got to keep your eye on the ball. The main goal, maximizing the value of the business for the owners, who are usually the shareholders.
That makes sense. So it's all about trading value and making sure the company is, in good financial shape and ready for growth.
Exactly. And speaking of different ways to set up a business, the study guide goes into the different types of business structures.
Okay.
It compares sole proprietorships, partnerships, and corporations, and points out their, unique features and what they mean in the bigger picture.
So it's kind of like laying out the different legal and financial frameworks for running a business, right? And the pros and cons of each one. That's got to be super important for anyone who's dreaming of starting their own business.
Absolutely. Choosing the right business structure can have a big impact on things like liability, taxes, and even how easy it is to raise money.
I'm starting to see how this deep dive is going to be useful, not just for understanding those big corporations, but also for anyone with entrepreneurial ambitions.
Definitely. One of the cool things about financial management is that the principles, they apply at every level, from, huge companies to small startups, even to our own personal finances.
So the study guide brings up something interesting about the goal of a firm. It says it's not just about, making a profit, but it's about maximizing shareholder wealth. Can you explain that a little bit to me? Those two things sound pretty similar.
Yeah, they are related. But there's a subtle difference that's actually quite important.
Okay.
Profit maximization is all about, just squeezing out as much profit as possible, often in the short term. Shareholder wealth maximization, though, takes a broader perspective. It's about increasing the value of the company's shares, but over the long haul. This means considering things like the timing of returns, the riskiness of investments, and how sustainable the business really is.
Ah, so it's not just about grabbing every last penny today. It's about building a company that's going to thrive and create value for its owners for years to come.
Exactly. It's a more holistic and sustainable way of approaching financial management.
Yep.
And you'll see this idea of maximizing shareholder wealth pop up again and again throughout the study guide. It's like a fundamental principle in finance.
I'm getting the sense that financial management is more than just crunching numbers. It's about strategy, vision, and taking that long-term perspective.
For sure. And speaking of thinking long-term and considering the impact of our decisions, the study guide also touches on the importance of ethics and corporate governance.
This is where things get really interesting, don't they? It's about making sure that companies are not just profitable, but they're operating ethically and responsibly, too.
Exactly. The study guide highlights those potential conflicts of interest that can pop up between managers and shareholders.
Okay.
And these conflicts can lead to, sticky ethical situations and what we call agency problems.
Like when managers put their own personal gain ahead of what's best for the company and its shareholders.
Yeah, that's a classic example. And to tackle these issues, the study guide stresses how important strong corporate governance is. These are the systems, processes, and principles that guide how a company is run and controlled. They ensure accountability, transparency, and ethical behavior.
So it's kind of having checks and balances in place to make sure everybody's playing by the rules and staying aligned with the company's values.
Exactly. And to really hammer home how important ethical behavior and strong governance are, the study guide includes this case study about African Bank.
Oh, yeah, I remember reading about that. That was a big financial scandal, and it shows how fast things can go south when ethical lapses and governance failures are allowed to happen.
It's a powerful reminder that financial management isn't just about chasing profits. It's about doing it the right way, responsibly and sustainably with integrity.
I'm really glad the study guide included that case study because it takes those ideas of ethics and governance and shows us how high the stakes can be in the real world.
I agree. Now, ready to move beyond the inner workings of a business and take a look at the bigger financial landscape. The next section of the study guide dives into the financial market environment.
Let's do it. I'm ready to explore that world where businesses and investors get together to trade and exchange all those financial assets.
This unit starts by explaining the role of financial institutions. They basically act as middlemen between savers and borrowers, making sure that money keeps flowing throughout the economy.
It's like a giant circulatory system for money, with institutions like banks and insurance companies and investment firms all playing these key roles in moving money around to where it's needed.
I love that analogy. You really captured the interconnectedness of the whole financial system. And within this system, we've got all these different types of markets, each one serving its own purpose.
Okay.
The study guide makes a distinction between the money market, where short-term debt securities are traded, and the capital market, where longer-term securities like stocks and bonds are bought and sold.
So the money market is for like quick short-term borrowing and lending, and the capital market is for those investments that have a longer time horizon.
You got it. And inside the capital market, you've got primary markets where new securities are issued and secondary markets where existing securities are traded between investors.
It's starting to feel like this really complex ecosystem, all these different players and markets all interacting and influencing each other.
It definitely is. And as the study guide points out, financial markets are becoming more and more globalized.
Meaning investors can diversify their portfolios by investing in companies from all over the world, right?
Right.
And businesses can tap into global sources of capital.
Exactly. It opens up a lot of exciting opportunities, but it also brings in new complexities and risks.
And that's where regulation steps in, right?
Yes.
The study guide stresses how important regulations are for keeping financial markets stable and fair.
Absolutely. Regulations are key for protecting investors, maintaining market integrity, and preventing those big systemic meltdowns that can impact the whole economy. The study guide even uses the example of the COVID-19 pandemic and how it hit the South African financial market,
Oh, yeah.
just to show how external shocks can really mess things up.
It was a stark reminder of how interconnected global markets are, how something happening on one side of the world can send those ripples, those shock waves, across the entire financial system.
You said it. Understanding the financial market environment is crucial for any financial manager
Yeah.
because it sets the context for all the decisions they make.
Wow, this has been quite the deep dive. We've gone from understanding what financial managers do to exploring those complexities of financial markets and why regulations are so important.
And we're just getting started.
I can't wait to see where this deep dive takes us next. Welcome back to the deep dive. In the last part, we covered a lot of ground from the role of those financial managers to that crazy world of financial markets. Now let's dive deeper into one of the most basic ideas in finance, the time value of money.
This is where things get really, really interesting. This idea of the time value of money, it's like the foundation for so many financial decisions, from investing to borrowing, even to planning for retirement.
I remember hearing that phrase, "A dollar today is worth more than a dollar tomorrow," but I never really got the logic behind it. Can you break it down for me?
Of course. The basic idea is that money you have today, you can invest it and earn a return over time. So a dollar you get today, it can grow into something bigger in the future.
So it's all about the opportunity cost of not having that money to invest right now.
Exactly. And to really get this whole time value of money thing, we got to grasp two key concepts: future value and present value.
Okay, let's start with future value. How do we figure out how much a certain amount of money, if we invest it today, how much will it be worth, down the road?
Well, the study guide gives us a formula for that, but let's try to understand it intuitively. Imagine you invest, let's say, R100 today at an interest rate of 5% per year. After 1 year, you're going to have R105. That extra R5, that's the interest earned.
Okay, that makes sense. So after 1 year, my R100 is worth R105. But what if I want to know how much it'll be worth after, say, 5 years?
That's where the magic of compounding kicks in. With compounding, you're earning interest not only on your initial investment, but also on the interest you earned in the previous period. It's like earning interest on your interest.
So my money's growing faster because it's like snowballing over time.
Exactly. To calculate the future value after 5 years, you'd use that future value formula. In this case, your R100 would be worth R127.63.
Wow, that's a big difference. So the longer I keep my money invested, the more I benefit from that power of compounding.
Precisely. And this is why starting to invest early, even with small amounts, can make a huge difference over time. The sooner you start, the longer your money has to grow.
This is really eye-opening. Now, what about going the other way? What if I know I want to have a certain amount of money in the future, and I want to figure out, how much I need to invest today to hit that target?
That's where present value comes in. It's basically the reverse of future value. It helps us figure out the value today of a future cash flow.
So if I know I want to have, say, R1000 in 5 years and I can earn 5% interest, I can use that present value formula to calculate how much I need to invest today.
Exactly. The study guide has a formula for this, but think about it this way. You're basically taking that future R1000 and discounting it back to its present value. You're taking into account the time value of money. In this case, you'd need to invest about R783.53 today to reach your R1000 goal in 5 years, assuming that 5% interest rate.
So present value helps me figure out how much to sock away today to reach my financial goals in the future. That's incredibly useful for planning.
Absolutely. Now, so far, we've been talking about single lump sum payments. But what if we have a stream of cash flows coming in over time, like loan payments or dividends from a stock?
That sounds a bit more complicated.
It's not as bad as it seems. That's where annuities come in. An annuity is basically a series of equal payments or receipts happening over a set period of time.
Okay, so like a mortgage payment or a car loan. Those are regular payments you make for a certain number of years.
Exactly. And just like with single payments, we can calculate both the future value and the present value of an annuity. This can be helpful for things like figuring out how much your retirement savings will be worth in, say, 30 years if you're contributing regularly, or figuring out the total cost of a loan over its lifetime.
So if I'm trying to figure out how much I need to save each month to reach my retirement goals, I can use the future value of an annuity formula, right? And if I'm comparing different loan options, I can use the present value of an annuity formula to see which one really costs me less in the end.
You got it. The study guide even walks us through some real-world examples of how to use these annuity formulas. It's all about bringing this whole time value of money thing to life and showing how we can use it to make smart financial decisions.
This is definitely making more sense. Are there any other time value of money concepts we should touch on?
Yeah, actually, there are a couple of variations on the basic annuity idea that the study guide mentions.
Okay.
One is the annuity due, where the payments are made at the beginning of each period, not at the end, like with a regular annuity. Think of rent payments. They're usually due at the start of the month.
So the timing of the payments can affect the present value or future value.
Exactly. An annuity due will have a slightly higher present value and future value than an ordinary annuity with the same payments and interest rate, just because those payments are happening earlier.
That's interesting. What's the other variation?
It's called a perpetuity, and a perpetuity is basically an annuity that just goes on forever. It's a stream of equal payments that never ends.
Forever. That sounds kind of like a financial unicorn.
Ha! It's more common than you might think. Think of a scholarship fund that's, set up to pay out a certain amount each year to students forever, or some types of bonds that pay a fixed interest payment indefinitely.
Oh, okay, that makes sense. So how do we calculate the present value of a perpetuity if those payments go on forever?
It's surprisingly easy. You just divide the annual payment by the discount rate. For example, let's say a perpetuity pays out R100 every year, and the discount rate is 5%. Well, its present value would be R2000.
Wow, that's fascinating. So even though those payments go on forever, we can still give them a present value based on the discount rate.
Exactly. We've covered a lot with the time value of money, but the big takeaway is this. When those cash flows happen, it matters. When you understand these ideas of present value, future value, annuities, and perpetuities, you can make much better financial decisions.
I totally agree. This deep dive has really opened my eyes to the power of the time value of money. I feel much more confident in my ability to, crunch the numbers and make smart choices with my money.
That's fantastic. Ready to move on to the world of risk and return?
Oh, yeah, let's do it.
It's closely tied to valuation, and it's essential to understand how financial markets work.
Bring on the roller coaster of risk and reward. Welcome back to the deep dive. We've explored what those financial managers do. We've navigated through that whole complex world of financial markets, and we even like conquered the time value of money. Now it's time to tackle these two big ideas that really go hand in hand, risk and return, and then that whole fascinating world of valuation.
Yeah, you're right. These concepts are like essential, especially for anyone who wants to get how those financial decisions are made, whether it's, investing in stocks or starting a business or even just like managing your own personal finances.
I'm ready. Let's start with risk and return. It's a topic that's kind of exciting and a little bit scary at the same time. After all, nobody wants to lose their money.
I get it, but the thing is, risk, it's just a part of any investment. The key is to understand it and manage it, not try to avoid it completely.
That makes sense. So where do we even begin? How do we start to think about and assess risk?
Well, the study guide talks about scenario analysis. This means thinking about those different possible outcomes, different scenarios, and figuring out how they could impact an investment or a project.
So it's like playing out those what if situations. What if the market crashes or interest rates go through the roof? What if like some new competitor pops up?
Exactly. When we consider like those optimistic scenarios and those pessimistic ones, and that most likely scenario, we can get a better picture of, what could happen. We can see the range of those potential outcomes and how risky an investment really is.
That sounds super helpful. It's like having a crystal ball or at least, a way to get ready for those unexpected things. But how do we actually measure risk? Is there a way to like put a number on it?
Absolutely. One way is using standard deviation, which is a statistical measure. It tells us about the spread of potential returns around that average or expected return.
Okay, so a high standard deviation, that means there's a wider range of possible outcomes, both good and bad.
Exactly. A higher standard deviation means more volatility, and that means more risk. A lower standard deviation means things are more predictable.
So if I'm like a really risk-averse investor, I'd probably be more comfortable with investments that have a lower standard deviation, even if the potential returns might not be as high.
That's a smart approach. You got to know your own risk tolerance. That's crucial for making good investment decisions.
Now, no matter what our risk tolerance is, I've always heard that diversification is like a key strategy.
You heard right. The study guide really stresses that. Diversification, it's about spreading your investments around, different asset classes, different industries, different geographic regions.
It's like that old saying, don't put all your eggs in one basket.
Exactly. When you diversify, you're lowering the impact of any single investment doing badly. If one goes down, others might go up, which helps soften the blow.
So diversification helps to minimize that risk without necessarily giving up on those potential returns.
That's the goal. Now, to really dig into how risk and return play out in those financial markets, let's turn to the capital asset pricing model, or CAPM.
Ah, yes, the CAPM. It's one of those terms I've heard people throw around, but I never fully understood it.
Well, the study guide gives a good explanation. Basically, the CAPM is a model that helps us figure out the expected return for an asset based on its risk compared to the overall market.
So it's like a way to see what kind of return we should expect for taking on a certain level of risk.
Exactly. And beta is a key idea within CAPM. Beta measures how much an asset's returns jump around compared to the market.
So a high beta stock that would be more volatile than the market, and a low beta stock would be, less volatile.
You got it. Those high beta stocks, they tend to move more dramatically than the market, up and down. While those low beta stocks, they're usually more stable.
That makes sense. Now let's switch gears and dive into that world of valuation. I'm really curious about learning more about valuing those bonds and stocks.
Great. Let's start with bonds. Remember, a bond is basically like you're lending money to a government or a corporation.
Right, and they promise to pay you back with interest over a certain time period.
Exactly. To figure out the value of a bond, we got to look at its face value. That's the amount you'll get back when it matures. The coupon rate, which is the interest it pays, the maturity date, and then what those prevailing market interest rates are.
So if interest rates go up after I buy a bond, the value of my bond will go down.
Exactly. It's an inverse relationship. When those interest rates rise, new bonds that are issued will offer higher coupon rates. So those existing bonds with their lower coupon rates, they become less attractive.
So there's a risk that comes with holding bonds if interest rates go up. I hadn't thought of it like that before.
And to help us figure out if a bond is a good deal, we can calculate its yield to maturity, or, YTM.
Yeah, from what I remember from the study guide, the YTM tells us the annual rate of return we can expect if we hold onto the bond until it matures, right?
Precisely. It factors in the bond's current price, its coupon payments, and how long it is until maturity. It's a really useful way to compare different bonds and see which ones are offering the best returns for a given level of risk.
That's really helpful. Now, What about valuing those stocks? That seems a little trickier, since the stock market can be so unpredictable.
It is more complex, for sure, but there are still ways to approach it. One common method is using the dividend discount model. The idea behind this model is that a stock's value is the same as the present value of all those future dividends it's expected to pay out.
Oh, so we're bringing those future cash flows back to their value today, just like we did with bonds.
Exactly, but trying to predict those future dividends, well, that can be tough. Companies can change their dividend policies. That's where those other valuation methods come in, like that discounted cash flow model or DCF. The DCF model looks at all the cash flows generated by a business, not just those dividends.
So it's a more complete way of valuing a company, looking at its overall financial picture and how much it could earn in the future.
Exactly. And there are other approaches too, like comparing a company's valuation ratios, like the price to earnings ratio or the price to book ratio, to those of similar companies or to the industry average.
So we can get an idea of whether a stock is overpriced or underpriced compared to similar companies.
Exactly. And remember, valuation, it's not a perfect science. It's a mix of quantitative analysis and qualitative judgment.
This has been, wow, an amazing deep dive. We've covered so many of those fundamental ideas in finance. I feel like I have a much better understanding of how businesses work, how those financial markets function, and how to make those informed decisions about investments.
I'm so glad to hear that. I hope this deep dive has given you the knowledge and the tools you need to navigate that financial world with confidence.
It really has. I'm feeling inspired to keep learning and exploring this whole fascinating field. Thanks for being such a great guide.
My pleasure. And remember, finance is always changing, so keep learning, stay curious, and never be afraid to ask questions.